Jomi Joseph is asking that, can you explain the technical term alpha generation for long-term investment in layman's language in simple method? Okay, every layman has the it's very hard to actually tell in layman's language, but I'll try. Which is most investors have the choice of investing in something which is risk-free. For example, the post office recurring deposit, or which is equivalent to a SIP, but your capital is protected, the interest is protected. Likewise, the other option you have is when you are investing in equity, that you don't put effort in choosing which fund to invest in, or trying to evaluate the brilliance of a fund manager or brilliance of a strategy of fund management. You always have the fallback in terms of the most risk-free equity investment option is an index fund. So if you do nothing, you earn as much return as index. So when you entrust your money to an active fund manager, you have to, it assumes that the alpha, the concept is based on that all the information available in the market is reflected in the stock price. So it is very difficult for investors to add value, because the market is very efficient and it factors all the price, all the information and news and outlook is reflected in the market price. Market is very efficient. But the active fund manager, what he's attempting to do is that market is not efficient. He's trying to look at mispriced opportunity. He's trying to look for opportunities where market is thinking something, or it is reflected in the stock price, but he thinks otherwise. So that is why you choose an active fund manager. That here is a fund manager who will do things which is not like that of an index. And when he's taking those actions, what is the amount of return? And here on a per unit of risk, or for a given level of risk, how much is the extra return generated by the fund manager? That is in a nutshell is referred as alpha. How is a fund manager beating the relevant benchmark? Because different funds can have different benchmark. So a relevant benchmark by assuming risk, because if there's a fund manager who's generating high risk as compared to index, but he's also assuming great return, high return as compared to index, but also assuming great risk, which is captured in the form in a formula of volatility or standard deviation. So that will be, so if one is assuming great risk and generating great return, it may not have great alpha. High alpha means that one is generating higher return than index by assuming lower risk than index as compared to index. So higher the alpha, better it is compared to index. But I would say that keep it simple. Look at a fund which is doing better than index in a falling market, falls less and rises more in a full market cycle, and the fund manager is still around, because this alpha and the kind of things. You heard the other question that why we don't have too many index funds or the kind of broad-based index. So index and all these, so these are all coming from very efficient or advanced markets to our market, and of course theoretically, academically they are fine, they are rooted in academics, but one has to see that doability of all this. It should be one of the things which you can look at, and at Value Research Online you go to the funds page and you look at the portfolio part, and you will be able to see all these numbers, alpha, beta, R squared, Sharpe ratio. So look at that, understand, it's good to know, but I don't think that should be the only driver.